Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me again today, the man himself, the governor of the great state of Texas, Mr. Michael Becker.
Hey, Paul.
How are you?
Things are going well. What's new in the Old Capital world?
Well, don't forget in the end of October, 24th, 25th, we're going to have the Old Capital Multifamily Conference. You'll see, if you can, come to that. We'll have 700 multifamily investors at the House of Blues. Don't forget to go on to oldcapitalpodcast.com and come on in and visit with us at this great event. Again, this one is a national conference, not a regional conference. This is the one that everyone comes to. That is in multifamily. It gives people a great opportunity to network with other folks. This year, our keynote speaker, as you remember, is Lou Holtz. Lou Holtz, Notre Dame, a head football coach for a number of years. He'll be talking about doing the right thing. So doing the right thing not only for your partnership, but for your lender in the transaction, but you're definitely your tenants and all your folks that you're associated with in your business. So doing the right thing. So look forward to seeing you at the Old Capital Conference in October. So we'll see you then. So, Michael, what is going on today? We have the great JP CONKLIN in the podcast to talk a little bit about what's going on with this interesting capital markets game that people, I think, are already starting to be aware of and see what's going on. So I'm going to kick it over to you, Michael, and let's talk with JP CONKLIN.
Yeah, so we're recording this podcast, early September 2019, and one of the things I read every Monday morning is what's called the Pensford Letter. It's written by a gentleman named JP CONKLIN from Pensford, and that's who we have on the podcast today. So JP, welcome to the podcast. Appreciate you coming on.
Good morning, and thanks for having me.
Yeah, maybe we kind of start off a little bit kind of with your background and maybe talk a little bit about who Pensford is and kind of what you guys do.
Yeah, absolutely. I started Pensford a little over 10 years ago to be an interest rate advisor to commercial real estate borrowers. And prior to that, I'd spent my career working at Wachovia selling interest rate derivatives to commercial real estate firms primarily. So my entire career has been spent working in interest rate derivatives and defeasance business. And over time, just naturally became more and more in tune with what was happening in the interest rate markets in general.
Good. So you guys are based out of Charlotte, and JP and I both left the banking from the evil empire because I was with a regional bank that got bought by Wells Fargo the same day they bought Wachovia. So I think we both have that in common. I didn't know if you knew that or not, but it was interesting times about 10 years ago when you're starting up Pensford. So what I thought maybe we kind of have two parts to the podcast. Maybe quickly talk through kind of the current state of the market with interest rates and kind of how you see it. It's been good and also challenging at the same time here in 2019, first basically finished 8 months or so of the year as we record this. And I think the 10-year treasury is down somewhere around 150 basis points from the beginning of 2019 to kind of when we record this podcast right now. And that's caused, people to be able to come in and get pretty low rates for a period of time. And then it's caused some yield maintenance prepayment penalties or defeasance penalties to skyrocket, screwing up a couple sales. One of mine in particular is personally painful. Kind of talking through kind of the state of the market, kind of how we see it now. And then we'll kind of maybe spend the second part of the podcast talking through some potential hedging strategies as people are kind of moving a little bit more away from the Fannie and Freddie, at least for the balance of 2019, and kind of getting to some alternative debt options that aren't your kind of traditional agency loans. So maybe kind of just give a little state of the market on kind of what you've seen over the last several years of the interest rates and kind of what are you seeing right now out there in the marketplace?
Sure. Once the Fed started hiking at the end of 2015, then they took another year off and they started hiking again. What we experienced was a general upward trend in interest rates. And we came off of the bottom that had been the result of zero interest rate policy. And it was really challenging to try to figure out where were we ultimately headed during that time. So there was a lot of discussion around what is the eventual landing spot for the Fed. And so the 10-year Treasury, which is really just supposed to be forecasting the future path of Fed funds, took off and ran up into the sort of 250s to 3% range and then waited for Fed funds to catch up. And as the Fed was hiking, they were trying to send signals to the market. Where are they ultimately taking interest rates? And the Fed had a very challenging task because coming out of zero interest rate environment, nobody really knew what to expect as the economy fully recovered. And they were trying to send signals and walk this fine line to send messages to the market to reassure that they weren't going to overhike, but also that the economy is doing well enough that we can continue to increase interest rates and the economy can absorb that and still continue to expand. What we saw was as they got above 2% with Fed funds, things started to slow down in the economy. The Fed was sending signals that they planned on hiking to about 3.25%, while simultaneously saying that they thought really the neutral rate for interest rates was really more around 2.5%. And so they were suggesting explicitly, we will be hiking beyond neutral in an attempt to control inflation. And what we ended up seeing was the inflation never materialized. And we speak with real estate firms all the time who say, how can there be no inflation? And there's a million different hypotheses out there for why real estate is experiencing inflation in construction costs and budgets, whereas the rest of the economy is not experiencing it. But the fact of the matter is that almost all measures of inflation continue to suggest that it is basically absent, and it is well below the target of 2% inflation for the Fed's goal. So this led the Fed to end up pausing in December after they had gotten up to the range of 225 to 250 and basically suggesting we're in a wait and see holding pattern. And let's just see how the economy does in 2019. Well, clearly things have not gone well, and part of that is self-inflicted with the escalation of the China trade war. And so the Fed has now had to come in and begin cutting interest rates. And that is actually very common after the last Fed rate hike. We released a study earlier this year that said after the Fed pauses, and we define a pause as 6 months with no interest rate increases. Once the Fed pauses, in every previous scenario, they have ended up cutting interest rates over the next 3 years, most of the time by at least 3%. So where we're at today is really not that uncommon. It actually fits the historical pattern of they Fed hikes, they pause, and they end up having to cut interest rates.
So you're seeing that that you know we got all the way up to about 225 to 250 was a range, and you're saying that the average cut's about 300 basis points or 3%. So are you seeing us going to zero to negative kind of in the foreseeable future? Is that what you're telling me that data tells you?
I'm saying it's definitely on the table. And I think what we will probably hear is even if the Fed does not expect to actually take rates negative in the United States, that they have been sending signals over the last year to convince the market that they have that ability if necessary. Because right now the market is worried the Fed doesn't have enough ammunition to fend off the next recession. And I suspect the Fed will spend more time trying to convince the market that zero is not the floor. Maybe negative 75 basis points is the floor. And if we can convince the market that negative 75 is the floor instead of zero, then that's the equivalent of having gotten Fed funds up to 3.25 and cutting to zero. We still have 3.25% to cut from day one. And I think that we'll hear a lot more chatter over the next 12 to 18 months about at least the Fed's ability to go negative, even if they don't have the intention of going negative.
Yeah, definitely uncharted territory for us here in the United States, seemingly to talk about negative rates. But, kind of looking at our yields relative to kind of the global yields, I have my screen up here right now. And as we record this, we're about 144 on the 10-year Treasury. And that is somewhere around 210 basis points higher than the German Treasury, which is negative 71 bips, and Japanese is negative 28 basis points. And for God's sakes, we're 60, 70 basis points over what the Italian 10-year is, which is about 90 basis points. So it seems like we're just kind of pulled down like a magnet because our yields are so much higher relative to kind of the other sovereign options around the world. Japan, Germany, kind of being the two most stable, strong economies. So you're basically seeing for the near to medium term, is there any way that you can foresee rates kind of reversing on us and running up materially and breaching 2%?
When we talk about interest rates, there's really two different interest rates. We have the short-term floating interest rates like LIBOR and Fed funds, and the answer is no. There's really no risk that those are going to reverse course and increase anytime in the foreseeable future. The 10-year Treasury, which I think is what you're really asking, is long-term fixed rates. What is the possibility that those might spike? And I would say really you probably need a couple things to happen in order for that to materialize. Number one, we need some sort of resolution with China. and the trade war escalation. I don't think that simply not getting worse will cause the 10-year Treasury to get back up to 2%. But if somehow we reached a full resolution and the tariffs were reversed, then I could see at least providing some room for the mentality of we can take some more risk now, and the 10-year Treasury may start to climb. I also think in conjunction with that, we need probably bold, aggressive steps from the Fed. And I think that right now the Fed is trying to nurse us lower without sending signals of panic. And the market is not interpreting that as good enough. The Fed is falling behind the curve again. They're going to be too slow to cut, and we're going to end up having another recession. Whereas perhaps if the Fed were to say, listen, we are going to cut 50 basis points, and then we're going to adopt a wait-and-see policy, that may send the sort of signal to the market that, hey, we are easing financial conditions immediately, not trying to nurse this. We stand poised to intervene more aggressively, but we think that the underlying economy is strong enough that if we just take our foot off the brake a little bit, the economy can continue to expand. And so some sort of aggressive intervention, more than just nursing 25 basis points at a time and sending signals about flexibility in 2020, may give the market enough confidence to say, you know what, this will not be a Fed-induced recession. And if China has some sort of resolution, we now have more of a risk-on mentality, and we could see the 10-year start to climb higher. All that being said, that's a confluence of events that seems pretty unlikely at this point, certainly in the near future. So I would be very surprised if the 10-year gets back up to 2% anytime soon.
So as the treasuries have been falling, one of the things we've noticed, in particular last, say 3 months, maybe since about April or May, is that we're starting to see spreads gap up quite a bit, credit spread. So, your interest rate is a combination either between your index plus a spread, whether it's an adjustable rate being, typically over 30-day LIBOR plus a spread, or your long-term 10-year plus fixed rate money being, your 10-year Treasury plus a spread. So we got a loan apped in, I think it was late April, early May, and we were able to get a spread of a 30-day LIBOR plus 156. About 3 weeks later, we did another loan, and the spreads gapped up to about 178 over 30-day LIBOR, and we thought we're kind of getting screwed. And today, it's probably same loans about 250 or so over 30-day LIBOR and going up daily, seemingly. So as these indexes have fallen, the spreads have certainly widened. Is that a trend that you're going to kind of foresee going forward? Because that certainly impacts the actual real rates that people need to pay on the money they borrow.
Yeah, I absolutely think that trend will continue. I think we are coming out of one of the most volatile months on record. And so it may be exaggerated right now. It might be artificially high right now for someone trying to price a loan. But I do think going forward, in general, as rates are falling, it's usually because of bad news. And so lenders start to price more defensively. And so it's natural that spreads would start to widen out. And I also think we'll continue to see lenders to really dig their heels in around interest rate floors. And those had become throwaway items as the Fed was rising interest rates from 2015 until December. That is going to have more and more economic value to both parties in this transaction. And if they're getting beaten up on the loan spread, they may counter with some sort of higher floor to ensure that the rate never drops below a certain level.
So what are you seeing right now on a traditional adjustable rate apartment loan? What are you kind of seeing as far as floors being put in? Are we seeing LIBOR zero floors? Are we seeing something above zero? What's kind of the range you're seeing currently?
Mostly we see floors being set at wherever LIBOR is on the day that the loan is closing. And then it's up to the borrower to push back and say, that's not acceptable. That's not your funding cost, so you don't get to put the floor there. I'm not going to bear that risk. And then the negotiation begins from there. So we've had a lot of discussions with our borrowers trying to provide to them ammunition to go back to the lender and say, this floor that you're embedding, if I were to trade this in the market, would be worth a substantial amount of money. And so I think you guys are basically backdooring some fees and revenue, and that's not what I've agreed to sign up for here. So let's have a reasonable discussion around where is the appropriate level to set this floor. 0% to me, I can understand. Seems like a reasonable number. We don't want to be dealing with negative interest rates if I'm a lender. Anything above that, now they're just trying to basically widen out their spread in a falling rate environment.
So we have taken on some adjustable rate mortgages where we have historically done a lot of long-term fixed rate just because of all the reasons you're mentioning. We're seeing multiple years of downward pressure on the rates. We think the risk to the upside is relatively minimal, at least on the short-term spectrum of the interest rate scale. You wrote an interesting article in the Pensker Letter last week that I read that kind of made me want to interview you on the podcast. And you kind of went through all the various reasons or various ways that you can hedge interest rates. So maybe you can kind of run through, maybe the top, 5 or 6 ways you can go through and hedge your interest rate risk if you're going to go out and take an adjustable rate mortgage. So I don't know if you want to maybe just kind of roll down some of the top 5 or 6 of these that you kind of see as potential options to hedge the risk.
I think the first thing that borrowers who are more accustomed to 10-year fixed rates should get comfortable with is the notion that floating interest rates is not inherently bad. We did a study and we went back and looked at comparing floating versus fixed interest rates. And what we found was, in a nutshell, that when you fix interest rates and you are wrong by a ton, and you end up dramatically overpaying in interest expense. It always feels better just intuitively to have a known interest expense, but you almost always end up overpaying, and usually by a dramatic amount. When you float and you are wrong and you pick the wrong time to float, you're only wrong by a little bit. So floating ends up being better approximately 98% of the time, depending on the time horizon that you're looking at. So 98% of the time, it's better to be floating with the benefit of hindsight. The 2% of the time that you were wrong, you were only wrong by a little bit. Whereas conversely, if you fix, you're usually wrong 98% of the time, and then you're wrong by a ton, and you're overpaying by 3 to 5%, generally speaking, again, depending on the horizon. So what I would first say is anyone who is more accustomed to dealing with long-term fixed rates, the short-term floating rate options are not inherently bad. I appreciate that they have different risk profiles over the next 10 years, but the amount of savings that you generate along the way, coupled with prepayment flexibility, generally makes them much more attractive once you get comfortable with them. And we had a lot of customers get comfortable with floating rates sort of 2012 to 2015 who never before the crisis would have dealt with floating rates because it was at zero and the Fed was clear that they weren't going to be raising. So people felt comfortable taking that risk. And then once they got comfortable, they were more comfortable doing that on deals going forward. So I think maybe that's the first message is don't just panic that my only option is a 3 to 5 year floating rate deal. That usually means you're going to save yourself money, particularly in the rate environment we're in, because the Fed is not hiking anytime soon. Whenever they do get around to hiking, they will send all sorts of signals well in advance that will allow people to prepare for it. And they're probably cutting pretty dramatically. And people will see their floating rates move lower, giving them the ability to better offset an economic slowdown or any issues they might have with tenants. All that being said, the most common way to hedge interest rates on floating rate deals is interest rate caps. These are fantastic instruments. They do exactly what they're designed to do, and they just put a ceiling on your interest expense. Today, they're incredibly cheap relative to where they were even 6 months ago. So we are getting back to the point like we saw in 2012 to 2015, where they're mostly about transaction costs because the market's not really giving any value to the instruments themselves. So for a lot of different structures, they end up costing sort of 15 to 20 grand. You pay the transaction cost, and now you've got a cap for the next 3 years. And
yeah,
really
we bought a cap from you guys recently. I think it was about $22 million, and it was, I can't remember what the strike was, a 378 LIBOR strike, and it was like 19 grand on 22 million. And what would that approximately have been, say, 6 months ago or a year ago? If we have a similar strike, it would have probably been well north of 6 figures, right?
Definitely would have been over $100,000. Absolutely.
Yeah. So that's basically the market. What that's telling us is the market is saying that, you're basically setting money on fire. There's virtually zero risk of it going above that strike rate. Maybe describe the way the cap instrument works mechanically if you were to actually get into a rising rate environment and have to, exercise the cap.
As soon as LIBOR exceeds the cap strike, that usually the lender helps dictate what that strike is set at. The cap counterparty, a bank, starts reimbursing you the difference. And then you pass that on to your lender and then in effect buys you back down. And so in a situation like we find ourselves today where LIBOR's at 207 and falling with no expectation for rising interest rates in the next 5 years, buying caps is incredibly cheap. The market's saying if you need to buy a cap at 3%, there's basically 0% probability that that's ever going to be used. And so the traders and the desks that sell these are basically just charging transaction costs. And they're saying, yep, we'll sell this to you. But like you said, we think that you're never going to need it. If you do, here it is, and we'll reimburse you the difference. And so I think it makes sense for borrowers when they have maybe investors that they're trying to keep happy, or they're less comfortable with floating rate interest rates. Maybe they've never done it before. It's a good way to just check a box relatively inexpensively. It's probably never going to have any value, but you know what? I have insurance on my home, and at the end of the year, I don't bang my head against the wall and say, man, I didn't get to collect on that fire insurance on my house. It's just insurance protection in the event that something unlikely happens. And right now, it's really inexpensive insurance.
What would the next most common type of interest rate hedge that you guys sell?
Easily swaps. Now, these are dictated somewhat by the lender being able to offer swaps. We get a common request of, can you help me? I'm closing with a debt fund. Can we swap this with, a more traditional bank? And you can think of all the big banks. And the answer is not usually. I mean, you're allowed to, but what's going to end up happening is you'll have to post collateral to that third-party bank to secure the swap exposure. Because normally, if you were to close a loan with one of those banks that offers swaps, they'll just use the underlying real estate to also secure the swap exposure. Well, if you close with a debt fund who does not offer swaps and you try to go to a third-party bank, the debt fund's not going to share the collateral. So let's assume that you're working with somebody who offers swaps. They make a lot of sense in this environment, even for shorter term, because you pick up immediate interest savings. You go from, let's say, 206 on LIBOR, and you might lock in sub 150 for the next 2 to 5 years. So for a lot of our borrowers, that makes sense because they say, just give me the fixed interest expense. I want to lock it in for the foreseeable future, and I'll deal with any prepayment penalty considerations down the road. These make great sense for anybody who envisions holding onto the asset for the term of the financing. Where we will push back on clients a little bit is if they think that they're going to be rolling this into a permanent deal 2 years from now because they're just trying to kick the can down the road, don't do a 5-year swap on a 2-year time horizon asset. Match the swap to the time horizon for the asset itself. And that way, 2 years from now, if you are able to go permanent, you don't have a 3-year tail on the swap and you've got to deal with a breakage penalty.
Do you typically see, or have you seen on the adjustable rate Fannie stuff being able to swap that, Fannie and Freddie, or they don't allow that?
They don't allow that. They are rolling out a template program. They had done those selectively pre-crisis, and I'm aware of exactly one swap in the last 10 years that they've allowed. They are generally opposed to them on Fannie and Freddie finances because they just don't want to deal with diluting the collateral, and they don't want to open up a swap desk and be able to offer swaps directly. So generally speaking, just assume if you're dealing with an agency for now, swaps are not one of the options.
Okay. What would be the next most common cap that or hedge that you guys sell?
Then we get into more like structured arrangements where we're trying to figure out what is the objective of this. If you just need to satisfy lender requirement and buy a 3-year cap at 3%, we get it. It's going to cost you $20,000 and everybody just closes the loan and we'll talk to you in 3 years. If you have more flexibility in that, such as you're getting a floating rate loan from a more traditional lender who does offer swaps, we can help customize a solution that achieves your interest rate objective. So normally we see clients who want to do, we call them step-up coupons, where you lock in the interest rate for the first 2 years at one level, and then it steps up to a higher level in the future, generally speaking, because you expect occupancy to increase. We're actually selling the reverse structure of that. Because they feel confident about where things will be for the next couple years, they're locking that rate in at a slightly higher level in exchange for a lower rate in the future. So we had a client who looked at a deal as a 10-year floating rate financing with a traditional lender, and they actually locked in the first 3 years at 2%, and then the last 7 years at 1.15, and actually had that step down. Wow. Just in the event that there is a softening in the economy. By then they figure, if we have tenants not renewing or dropping out or going dark, by then we will drop our rate down to 1.15. We'll be better positioned to absorb that.
Wow. So as far as pricing goes, is there a dramatic increase to that stepping down that far in the future, or are we seeing the market conditions absorb a lot of that and it's still pretty affordable?
It's very affordable. The yield curve is so flat that you can manipulate it to basically achieve any objective that you want. So if you just tell us, here's what I really want to hedge, we can come back to you with a couple different alternatives, and then we start to fine tune it and really dial into the final specific structure.
That's good. So one of the things that's been extremely painful for us here lately, and I know you spoke with my partner Sean about this quite a bit ad nauseum, and we unfortunately chose not to hedge, but we have a few loans that properties we're trying to sell that had fixed rate loans on them, and we have yield maintenance prepay, and we had one that we agreed to sell in May that ultimately ended up blowing up in August because the prepay just ran away too far from us. How do you hedge, or can you hedge against declining rates when you have a yield maintenance or defeasance prepay? Is there anything you do to kind of offset that risk when you're getting into escrow to sell a deal?
Absolutely. So we spend a lot of time talking to clients about using swaptions. It's just an option on a swap rate in order to hedge future fixed rate interest rate locks. So they're very common on, let's say, a CMBS financing, or if you know that you'll be pricing with a life co at some point down the road, or even on an agency fixed, before you're allowed to actually lock in the rate. And so they're very common in that capacity, but they also work in reverse. And so if you have a closing that's 45 days out, you're worried about what's going to happen to interest rates between now and then. You can buy a swaption that will protect against a drop in interest rates so that if the rates go through a certain level, you start to get reimbursed for that difference. And that way you can really lock in your known worst case scenario, prepayment or yield maintenance or defeasance on the upcoming closing that you have positioned. So those have become far more common in the last 3 months. The year before that, we probably only sold a handful of them. Now, almost every day, we're talking to clients about how to hedge a worsening yield maintenance or defeasance calculation.
Cool. Is there anything else around interest rate hedging that you want to kind of talk about that I didn't ask you about? Anything else that's kind of top of mind or topical that the listeners should know about?
I think the most important thing is to just give us a call and tell us what you're trying to achieve, and then we can help you craft a strategy that will meet those objectives. Rather than trying to figure out, should I just be doing fixed or should I be doing floating? Let's have a discussion around how do we formulate the ideal structure that helps everybody get comfortable, but also minimizes risk and gives you as much upside as possible. Because a lot of times we find that our borrowers, they think it's all or nothing. I'm either doing 100% fixed for 10 years or I'm doing a 3-year floater. Well, we can work with you to try to figure out a structure that will mitigate interest rate expense while also giving you the flexibility to go do what you want to do in the debt markets.
Quick question that I had concerning LIBOR. I mean, what is your crystal ball saying about, LIBOR is going to go away? What's it going to be replaced with, or what's your take on that?
There's no doubt that the regulators have been hard at work trying to find a suitable replacement for LIBOR. The ultimate objective is let's move away from something that is a survey of banks and make it a more market-driven index. The challenge that they are finding is the market is very reluctant to move away from LIBOR. So although they've given this goal of 2021 as being when LIBOR will be replaced, the current replacement being SOFR, Secured Overnight Funding Rate, I put the odds very low that by 2021, LIBOR ceases to exist. If between now and 2021, the market has fully adopted SOFR and it's a relatively painless transition, then yes, I think that will happen. I don't think in 2021, if the market has not adopted SOFR as a suitable replacement, the regulators aren't going to yank the rug out from everyone and say, well, too bad, we told you you had 3 years to prepare and you didn't, and we're eliminating LIBOR. I think what they've really said thus far is in 2021, we are cleansing our hands of regulating LIBOR. And if you guys find yourselves in trouble again, you can't come to us and say, hey, I thought you guys were regulating this. So instead, we're stepping back, we're cleansing our hands, we're trying to give you a suitable replacement. I am not hearing from the traders that we speak with that there is any liquidity or depth to this market in SOFR yet. So I don't see really any chance that LIBOR is gone by 2021, even though that was the regulators' original intention.
And JP, when's the next time I'm going to be able to get one of those negative interest rates out of my $5 million apartment loan?
Any day now, probably.
So, Michael, why don't you finish it up?
JP, I really appreciate you taking some time this morning and recording the podcast with us. It's been, certainly a choppy environment out there, and something we haven't seen in a while, that we're starting to see the declining interest rates. It's been, almost a decade basically since we've seen rate cuts, and we expect several more coming forward. And, it's certainly, like I said, it's been kind of good from the standpoint that, declining rates has certainly helped keep the wall of capital coming at the multifamily space or commercial real estate in general. But, spreads are certainly gapping up. So the real, you're not seeing dollar for dollar savings anymore. I think the best time, obviously, with the benefit of hindsight, was around, March to May to try to lock some of this stuff in. Now they're going up, but, 10-year fixed rate money is still kind of plus minus 4%. And in your floaters, you're getting 250 plus spreads over LIBOR, and watch the floors. That's certainly a good value add for anyone to kind of get into these deals. Make sure that you're negotiating through some of the floors that you might see in some of these either agency loans or life co loans or debt funds, et cetera, that are out there in the marketplace. And I couldn't think of a better person to recommend that if you guys are looking on trying to price out fixed floating, your caps, your hedges on these things. JP is a guy that we call and we've used multiple times personally, so I certainly would endorse him. So JP, if anyone wanted to know more about you, how do they, one, reach out to you, and then two, how do they get a copy of the Pensford letter emailed to them weekly? Because I personally find a lot of value of that, and that's something I read every Monday morning when you send it out.
Best way to get a hold of us or to sign up for the newsletter is to just go to pensford.com. That's PENSFORD.com. And we have a button there where you can click to subscribe, as well as all of our other interest rate thoughts on the day.
Paul?
Well, some great information, boy. We'd love to have you on maybe on every 6 months and kind of just talk a little bit more about what's going on with interest rates and having people know a little bit more about the insurance that you guys do with these falling rate environments and possibly rate environments in the future. So great information. We appreciate that, JP Conklin with Pensford. Mike, thanks for joining us again today on your podcast. We appreciate that. And then I'm Paul Peebles. I was JP Conklin, Michael Becker. Have a great day. Thanks.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.